Right, ladies and gentlemen, I think it's pretty much bang on 11, so I will start this session. Um, Good morning, and thanks for you. Thanks to all those who have joined today's session as advertised. If I can get my there you go. Is the third in the series of our webinars on pension. This one is on pension sharing and the lifetime allowance. And just a couple of housekeeping bits before I start. Firstly, I'd like to thank my colleagues Jeremy Jackson and Anthony Saunders for joining us today as facilitators. And we found that we've run webinars in the past. We've had lots of questions. So Anthony and Jeremy are there to help answer the questions, which I'll be grateful if you would put in the chat box as we go through this 40-minute webinar. At the end of the webinar, we'll be putting into the chat box a web link to a survey, a short survey, which would be really grateful if you were complete. I know lots of you have done it before, and thank you for your comments. This one probably in particular would like to know what you thought of the technical content of today, because the lifetime allowance is deeply technical, and I've tried to simplify it as much as possible, but we'll see how well I've done at that at the end. After this webinar, you will be sent a copy of the slides and a copy of the recording. So I won't be necessarily reading everything off the slides verbatim, because it will be there for you to refer to should you wish. We've also in the past been asked to keep the webinar open for a while afterwards to allow those of you who've got questions to continue asking questions. So we will keep the webinar open until it naturally, I guess, dies a death when you finish asking questions. So the objective today, or the agenda today, is to talk a bit about the lifetime allowance. What is it, and how it affects people, and how it can be managed. We'll also talk about, of course, how it works with pension sharing, and how we approach it and how it should be approached, and also the pitfalls that present themselves when implementing a case where there's a lifetime allowance issues present. And finally, of course, when it's all done, these larger cases of some wealth are likely to have slightly different considerations when we engage with individuals, if we do engage with individuals post pension sharing, on how to rebuild the finances. So I'll cover that a bit. And for those people who are new to this series of webinars, just one slide on who BlueSKY are. Well, we are a firm of chartered financial planners, not actuaries. We've been doing pension sharing reports since the year 2000, when the legislation changed and pension sharing came in, particularly with this webinar on the lifetime allowance. There is need in many cases for the provision of regulated advice, of regulated financial planning advice, which as a firm of chartered financial planners we're able to do. And that's something that we find is of value, perhaps over the personalised advice with actuaries really can't give. You'll note from the logos at the bottom that we are members of Resolution. Rob and I are specialists, members, having been through the accreditation, training and examination with Resolution. So with no further ado, what is the lifetime allowance? This is the revenue description of what the lifetime allowance is. And essentially, if I'm trying to put it in layman's language, it's how big can your pension fund get to without you having to pay tax on the excess over a prescribed limit which is set by the revenue. And the revenue have complicated our life, and certainly complicated financial planning, by changing the lifetime allowance over the years, as is shown in that bar chart. And in 2006, some of you may remember the days of what were called pension simplification, or A Day. And at that time, the revenue set the lifetime allowance limit at 1.5 million. Subsequent budgets increased it to 1.8 million, and then had a gradual decline where it went down to 1 million, and in 2016. And then the government said, well, it's gone down to 1 million, but we're going to index it now with CPI. And the indexed rate has got to just over £1 million now, 1.0731 million. But many people may know that the last budget actually froze that. So that final lifetime allowance level is now set for the next 5 years, I believe. So that's where we are with the lifetime. That's where we are with the lifetime allowance level. If you look at the history of how many people it's affected, you'll see that this is just over the 10 years since the inception of the lifetime allowance. So you'll see the number of individuals that have ended up paying it has increased, as of course the tax revenue has increased. And that has continued, although I don't have a graph of it, that has continued since 2016-17. And in my opinion, it's difficult not to agree with the fact that the lifetime allowance will become an increasing issue for more and more people. And the reason why that is that certainly we're all aware that the government needs more revenue now. And this is an easy way, the lifetime allowance taxation is an easy way to raise some more tax in a manner which isn't perhaps is perhaps a little bit more subject to smoke and mirrors than many other forms of taxation. Of course, what we've also seen, we're talking about personal pensions now, and fund growth in personal pensions in the past has exceeded the lifetime allowance increases. So we see more people with even personal pension funds falling into the lifetime allowance charge period, and those with final salary pensions, generally those with more wealth will have seen salary increases higher than the increases in CPI. So even people with final salary schemes are finding that they're more regularly caught by this tax. And of course, now we've frozen, now the lifetime allowance has been frozen until April 2026. You can see that more and more people are just going to wander into, maybe sleepwalk into the lifetime allowance taxation. Just to try and help you understand pensions a bit more and how it works in the context of the lifetime allowance, we're talking now about a defined contribution scheme. So these will be personal pension type schemes. And these will be a scheme which is owned by an individual, and the money that accumulates in the fund will come from contributions that you or your employer make, and will be subject to something called the annual allowance. And I'll talk a bit more about that later on. But effectively, the annual allowance is what limits are applicable to how much money you can pay into the pension scheme. The valuation of that personal pension, that DC pension scheme, is based on the number of investment units inside the fund and what price per unit those shares or units are. And that's a simple calculation which people will see on valuation statements. At retirement, you get 25%, generally get 25% tax-free cash from the pension fund, and the rest of it will provide you with a taxable income. You can accumulate your pension fund up to the level where you start hitting the lifetime allowance. And that lifetime allowance, as we've mentioned, is just over £1 million. So if your fund grows beyond that, then you will find that tax is due on the excess, and that tax is either 25% if it's taken as income, or 55% if it's taken as a lump sum. Mathematically, they both work out the same, because that 25% tax charge is in addition to your income tax rate anyway. 55% is if you take it as a lump sum. I'm going to be assuming, and this is our experience, that most people will take the excess as a lump sum, and therefore 55% tax is applicable on that excess over the fund size. That's fairly easy to work out. I've got a worked example in a moment. If we're looking at defined benefit schemes, so these are final salary schemes, these are schemes where the pension fund effectively is owned by all the members. That fund is funded by the employer and the employee, and it's the scheme administrator who works out how large that pension fund needs to be in order to guarantee benefits to the members. And that's a big difference between defined benefit schemes and defined contribution schemes, where the benefits under defined benefit schemes are guaranteed. So if we have a retiring member, he will have benefits paid to him, which are based on how many years he worked for the scheme and his salary while he was working for that employer. His lifetime allowance is tested on his benefits, not his fund size. His benefits, of course, as I've said, are based on the number of years service that he's worked for that employer and his salary. And the calculation is shown there at the bottom. His lifetime allowance valuation is the pension benefits he's got times by 20 plus the lump sum if there's a lump sum payable in addition, as there is with many pension schemes. So one thing to bear in mind is that, and I'm just hauling out a example from a previous webinar, is that let's say that an actuary has quoted that the cash equivalent for this member is 2.2 million. Now that's the value that the scheme members would give the member if he were to transfer out of the the company pension fund into his own pension fund. However, the valuation for lifetime allowance purposes in this instance was 1.7 million. So you'll see, and then the big message here is that when you get to see cases and C's quoted, is that the lifetime allowance valuation isn't the same. I don't think I've ever seen a case where it is the same as the cash equivalent. So just something to be aware of there, that they are two different figures. One's calculated by the revenue, the other one is calculated by the actuary. And just as an aside, I suppose, to add to your understanding of the lifetime allowance, we know the current lifetime allowance is just over $1 million. And if we're talking about a defined benefit, final salary pension, and you divide that by 20, assuming no lump sum is payable, then the maximum pension that the member can get without running into any lifetime allowance issues is £53,655. So if you see someone with a final salary pension over 53,000 odd pounds, you know that they're at or near the lifetime allowance limit. Curiously, where this legislation perhaps frustrates many is that if you don't have a final salary pension scheme, but you have a personal pension, a defined contribution plan, then if you wanted a pension of £53,000, then through the purchase of an annuity, to give a like with like comparison, you'd need a fund size of about 2.6 million. So here you have a a member of a company pension scheme who's got £53,000 of a pension benefit, and he's lifetime allowance free, and here you've got a member who's or an individual who's member of a personal pension scheme, and he wants the same level of pension benefit, but now he's got a fund size which is going to be subject to a fairly heavy tax charge because of the lifetime allowance level. So one would hope, maybe naively, that the government will perhaps address this anomaly, but it's one that exists and does cause some frustrations. If I move on just to an example here of of a case that we've triaged, and just to give you an idea of how the lifetime allowance works. Here we've got a wife. She's in the teacher's pension scheme. She's also got a personal pension with Zurich. You'll see that the teacher's pension scheme have come up with a valuation of 688,000. But when we work through the lifetime allowance, we will see that 20 times the pension plus 1 times the lump sum gives us a lifetime allowance valuation of £989,000. So we know that there we go. We've proved that those two are not the same. And add to that the personal pension, we will see that there's a lifetime allowance valuation for the spouse, which is in excess of the current lifetime allowance limit. But you'll notice here that the state pension isn't added to the lifetime allowance calculation. So here we've got a lifetime allowance issue, and just to work through that from a taxation point of view, the excess, the amount over the lifetime allowance is £40,000, tax payable £22,000, and who is that, or when is it tested? Well, it's tested through a number of events, and those events are all called benefit crystallization events, or BCEs. And the top 3 benefit crystallization events are that the lifetime allowance is tested, obviously, when benefits are taken, or on death if it's before age 75. And if you haven't died before age 75, when you get to 75, it's going to be tested anyway. There are no ways out of this. So even those people who don't crystallize or take benefits from their pension are going to be caught whatever happens. And if you think you can jump through a hoop somewhere, then there are 13 different events which the revenue say are benefit crystallization events, when they will test your pension funds against the lifetime allowance. Just to add a little bit of complexity to financial planning, is many schemes offer death in service benefits, which may well be included in the lifetime allowance calculation for members who die before age 75. So you could have someone who pension-wise is under the lifetime allowance, but if they were to die, they could find that their spouse, for example, may have a lifetime allowance charge because of the death in service benefits which are payable. If I just move on, or move back actually to this graph, you'll notice that there are 3 events when the lifetime allowance has tumbled from the 1.8 to 1.5 and so on. And of course, from a financial planning point of view, or even from a member's point of view, if you had built and done all your financial planning towards a fund of 1.8 million, and the government then reduces that level, then that could cause some frustration. So to try and get around that, the government brought in ways of protecting your lifetime allowance or your pension fund, and you'll be pleased that I'm not going to go into each one of those in detail, because there is a lot of detail behind this. But basically, there are three main forms of protection that you can apply for, and it's subdivided depending when you applied for that protection. So this is where you would apply online to the revenue to have your pension fund, your lifetime allowance protected at various points in time. There are all sorts of rules and regulations. In addition to those levels of protection, there are instances where someone who inherits a pension share or receives a pension share can actually get a lifetime allowance credit when they receive that. And additionally, and this is where a bit of financial planning comes in, there are two forms of protection that you can still apply for. Again, subject to certain criteria. I've got an example coming up on this, but you can see how complex all this can become. So that's a short history in the lifetime allowance and the relevance to the lifetime allowance and pension sharing is that I'd imagine you now understand that a lifetime allowance taxation can reduce the benefits that a member will receive, and if you're looking at sharing pensions on divorce, it's going to reduce benefits payable to both parties. The existence of protection, if a member has lifetime allowance protection, it can change everything. It can change the calculations that we perform. Furthermore, one thing we have to consider is that in some cases, pension sharing can mean a member loses the protection which he had applied for. And that has to be considered as well. When we come to rebuilding benefits, it can also affect how you rebuild benefits and whether you can rebuild pension benefits. And funny enough, I've just got an inquiry on this first thing this morning, but this is the first time we've dealt with attachment orders or earmarking orders for a long time. But if there are lifetime allowance issues present, and for whatever reason you fancy doing a attachment order rather than pension sharing, then care is needed there as well. How do you make steps to address that? Well, triaging a case, and I've talked about triaging cases in earlier webinars, is important. And in this instance, do you get a feeling that there might be a lifetime allowance issue in the case that you are dealing with? One of the questions that's useful to ask if this is likely to be an issue is, has pension protection been sought? And if it has, then there should be a certificate. These are challenging things to get from people because often they don't even remember doing it, or someone else might have helped them do it. But there should be somewhere lurking a certificate for protection. Even if they don't have one, then in some cases protection is still possible to retrospectively apply for. All in all, this is an issue that needs to be addressed in a letter of instruction. And certainly, again, something we've talked through and we'll continue to talk through in our webinars is, if you discuss a case up front and allow us to help you triage it, we can often spot these issues and give a bit of guidance in how to approach a case and what to put in the letter of instruction. And while we're talking about a letter of instruction, this is some wording we had from Hess in one of his cases where he helped put together a letter of instruction, that he recognized that there were lifetime allowance issues and wanted us to comment on those in our report. Now, we would go a bit further if we were to give you an example of our own suggested wording. You'll get this in a copy of slides. I'm not going to go through it because it's quite wordy actually, but it's quite wordy out of necessity, because we would always suggest that you ask us to consider any lifetime allowance issue which might be present, and that should form one of the questions in our letter of instruction. How is it dealt with on divorce? Well, a couple of points here is that if you are the person who's paying the pension debit across, then it won't count towards your lifetime allowance if you haven't taken benefits from your pension. So if you haven't opened a pension, you've still got that pension fund there, then sharing it is, if you like, of benefit, because you could pull yourself out of any lifetime allowance issues. We have pondered occasionally whether a way of managing a large pension fund is to get divorced and therefore share your pension, because when your spouse receives the pension share, it counts towards their own lifetime allowance. Again, unless the benefits are already in payment, and if the benefits are already in payment, then it means they will have already been tested. So there is the option of applying for an enhanced lifetime allowance credit, if that's the case. And my third point on this slide is always ask the expert to consider lifetime allowance implications and include them in the calculations. And we often see, we're often asked as shadow experts to review actuarial reports that have been done, and we often see that an actuary's report may have brought attention to the fact that a lifetime allowance issue is present, but haven't included it in their calculations. And that troubles us a bit, because if I use this as an example, if we are modeling someone's future income through cash flow modeling, and just to very simply explain this cash flow model, we've got a black line here, which is someone's expenses, where we haven't included lifetime allowance, any lifetime allowance taxation in the calculations. What we will see is these blue bars are where each year the assets that this individual has fills or satisfies the expenditure that that individual has in that year. So we can see that every year, in this instance, the assets, the underlying assets, have provided sufficient income that that individual has told us that they want. However, if we then included the lifetime allowance tax charge in our calculations, we can see that in this instance, at 75, there is a whopping great tax charge, because that's the benefit crystallization event at 75 they've had to pay. It's resulted in a shortfall, shown by the red bars, in their income in later life. So you can see the difference between excluding and including can be quite significant. And while we are making various assumptions about what the lifetime allowance would be, of course, it seems, in our opinion, the only option in pension sharing reports is to include calculations that assume a lifetime allowance tax charge, and we include that in the figures. So let me work through a case study where it's a fairly simple case study, or it has been simplified. Husband and wife, they're both the same age. They're conveniently the same age. They're both in good health. The husband has a SIP worth 4.7 million. He hasn't drawn any benefits yet. What we also know is that the husband has enhanced protection 2006. And sorry to bring in this little bit of techie stuff, but what enhanced protection means is if a member has it, this individual applied for it in 2006. It gave him full protection from the lifetime allowance tax charge, but on the understanding that he couldn't pay any further pension contributions or have any further pension accrual in any pension scheme. So he's got enhanced protection. He's a lucky man. Now, if he went through the process of sharing his pension with his wife with no advice, you could easily be forgiven for saying, well, it's a money purchase, it's a DC pension pot, both people could potentially, through annuity purchase, buy the same benefits. So we should split the fund 50-50. That seems quite sensible. The next line here is because the husband's got protection, it includes an element of tax-free cash protection, which means that from that fund he can take a bit more tax-free cash. The big issue here is that he doesn't have any lifetime allowance tax charge to pay because he's exempt. However, his wife does have a large tax bill to pay, which means that although you've shared the pensions 50-50 after tax, they're obviously not the same. So you haven't created equality of income because the lifetime allowance tax charge hasn't been considered. If we took advice, or if he took advice, our advice, and this is a case we dealt with some years ago, or similar to one we dealt with a couple of years ago, we suggested that the husband crystallizes his pension fund and takes tax-free cash. So we're saying open the pot, takes a maximum tax-free cash. Now, because he's done that, he's triggered one of these benefit crystallization events. He now has, he's now tested against a lifetime allowance, but because he's got protection, he doesn't pay any tax charge. Now, if I just go back a bit and work through this, he's taken tax-free cash. It's been agreed that they share that between the two of them. So step one is he's opened his pension pot, taken tax-free cash, shared it. He's then able to share the pension fund 50-50. There is no tax charge because he's got protection and he has now been tested. When the wife receives her pension fund, it's already been tested, so she has no further tax to pay. The net result is that they end up with the same size pension fund, the same size net pension fund, which means that having taken advice, they've saved £319,000 of tax. Hence the benefit of taking a bit of advice. And if you think about this from a timeline point of view, this would have to happen as part of the pension sharing report and certainly before implementation in order for this to work. If I look at another case study number 2, a wife receives a pension share of 1.24 million from her husband. The other material points here is that the wife does have a pension scheme currently, but it doesn't allow any transfer in. She hasn't. She's not working now. Hasn't worked for many years. Hasn't paid into a pension scheme for many years. And again, without advice, this 1.24 million is over the lifetime allowance. She would have to pay a lifetime allowance tax charge when she inherits this pension share of £92,000. Now, if she takes advice, our advice would be that she applies for Fixed Protection 2016. As I've mentioned before, this is still able to be applied for. It gives her 1.25 million of protection, as long as she hasn't paid into a pension since April 2016, which is the case here. And that would include she would lose protection if she did start a new arrangement or make any further pension contribution from here on in. Now, in this instance, because we've applied for Fixed Protection 2016, she is now covered by 1.25, which means that her lifetime allowance tax charge is 0. Because she's taken advice and we've told her to apply for Fixed Protection 2016. There is an order which this needs to be done. And if I'm showing this schematically, because there's a little nuance here to discuss as well, is here's the wife's pension share of 1.24 million. One option is she could pay into a pension scheme, but as we've discussed before, the existing scheme won't accept transfers in, and therefore transferring her pension share to an existing scheme in this case isn't isn't possible. She could start a brand new pension. However, and I don't make the rules up, these rules, this bizarre rule is a pension share would be deemed a new contribution if a new scheme was set up, and therefore the tax charge would still be applicable of £92,000. Why the revenue call it a new contribution, I don't know, but they do. So the other option is for a new scheme to be set up, but the existing pension transferred into the new pension. This new pension, I guess, in my own terminology, is now not a new pension because it's a pension with an existing pension transferred into it. It then means, as step two, that the wife can transfer 1.24 of her pension share into the new pension because this is deemed an existing scheme. This transfer is not deemed a new contribution, and therefore no tax charge applies. That saved her £92,000 of tax. And my point there is that the order, not only the advice is important, but the order of implementation of pension shares can also be really important. If we move on to rebuilding benefits, and often with large money cases, there will be issues about, well, where do I go from here? I've halved my benefits. If you were the person who was paying away a pension share, what can I do? How will my life look after the decree absolute? That would involve us reassessing that individual's needs and their various attitudes to risks. And one of the things I've touched on before, if you remember, we talked about annual allowance issues and how much people can pay into pension funds. Well, rebuilding benefits through pensions may not be possible. I'll come on to that in a minute. So we would then have to consider what are the alternatives to pension funding and what actions are necessary as part of that financial planning exercise. And what's often present in large, well, I suppose what I call large wealth issues, are that from a lifetime allowance, I'm going back to the lifetime allowance issues here, is that the maximum that you can pay into a pension and receive tax relief on is between 40,000 and 4,000, depending on your income. So if you've got high income, then it could limit your ability to pay more into a pension. That's what's meant by the annual allowance. And the other issue that raises its head a lot is that pension contributions and or pension sharing can mean that pension protection is lost. So before we look at rebuilding, we have to consider what the consequences are of someone paying further money into a pension. So there's lots of issues which are present there. And of course, what we're looking to do, going back to a slightly more detailed cash flow model, is we're trying to look to eliminate this shortfall with careful financial planning. It may be, of course, that one of the benefits of cash flow modeling is that it helps people to realize and maybe reset their expectations on what income they can have post-divorce. So the whole cash flowing exercise can be quite beneficial from that point of view. And as I've mentioned before, from a point of view, I'm just showing previous slides here from a point of rebuilding benefits. And this is why I used the term earlier of contributions which are limited by the annual allowance. If you've given some of your pension fund away, you might think, well, I can rebuild it, but you might not be allowed to because of the annual allowance issues. And likewise, with defined benefit schemes, the annual allowance is what is calculated on the benefits that someone has in a pension scheme, and therefore there are limits as to how fast someone can accrue benefits within a pension scheme before they break their annual allowance rules as well. So annual allowance limitations can exist, meaning that pensions on their own might be difficult to rebuild. It's an important part of the pension sharing process. So the summary, the summary is, I hope you, I think we're just about 40 minutes. The lifetime allowance issues are complex, and more people are going to be affected by this. So be careful that you don't kind of sleepwalk into this, and because lots of people do. A recommendation is to seek guidance early, discuss it. We'll help you think through the options and the way of approaching this. And this could be how to approach it as a single joint expert, or on a shadow expert basis. So whichever way you are working, we can help you think that through. Obviously, be careful with big cases at all stages, whether it's at the sort of triage stage, or the report stage, or at the implementation stage. And financial planning from a PODES, first time I've used this, the pension on divorce expert, you hope you will have seen, can save vast amounts of money. The lifetime allowance and the issues are pretty well documented in the PAG report. And just a plug for the PAG report, it's this, the PAG report is that guide to treatment of pension or divorce. And in it, you will find guidance also about how you find a PODE, and we've covered that in previous sessions. So that's a slide you'll also get a copy of, which just details some of the services we offer to help you through your work with your clients as single joint experts or shadow expert work. There is a resource page on our website where you can download forms, sample templates, etc. And that's it. As I've mentioned earlier, do let us know what you think. That would be fantastic. The SurveyMonkey link there, and I believe one of my colleagues is going to also drop that link into the chat box, so you can hopefully click it and get there straight away. Our next webinar, which will be number 4 in the series, will cover 40 minutes on pension valuations and when is a value not a value, and whether you should even ask a question about what the true value of the pension is. So we will cover that. And if you want to keep up to date with the BlueSKY thinking and what we're doing, then when you go to our website, you'll be able to see that you can sign up for our newsletter, which would keep our matrimonial lawyers abreast with that kind of technical stuff. Hope you found that useful. Now, I haven't heard anything from Jeremy or Anthony because they're muted, so I don't know whether they're all good, whether there are any questions or anything like that that would be helpful.
Everything looks good from my point of view, but there's something I probably want to raise, Mark. If we head back to the slide where you were comparing the 53,000 that you can get in a DB pension versus the 2 million you need in a DC pension, one thing that does potentially make it as an option for clients is if you're going to lose a lot of value because somebody's been working for BP for years and has a giant DB scheme, but in transferring, they're going to lose a lot of value between the two of them, we could always consider looking at offsetting. So you try make up the difference in value in benefits that aren't part of the pensions. That way you can avoid the lifetime allowance issue for the receiving partner. If the defined final salary scheme won't let them become a member of the thing. So when you've got a case where there's a lot of final salary value, it's worth usually just giving us a call, because it might cost a bit more to have offsetting calculations thrown into the letter of instruction, but in the long term, it could save the members an awful lot of extra cash.
Yeah, I think Anthony, that's relevant, and I think one of the slides I had considered putting in was the interaction with offsetting and the lifetime allowance, and I think that was a step too far because, of course, if you have high value pension schemes and you are trying to maximise the lifetime allowance for both parties, then if you like dilute that by offsetting, then sometimes you can compound a lifetime allowance issue because you've removed the ability to, let's say, share it between husband and wife, and therefore eliminate the lifetime allowance issue completely. Maybe I should have had an example on this, but if you had a if the husband had one pension which was twice the lifetime allowance limit, and he shared it equally with his wife, they would both now not have a lifetime allowance charge. But if you then brought in offsetting to reduce that share, you would then mean that one person is left with a lifetime allowance issue. So here we go. So we mustn't get in a technical, we mustn't get into too deep a technical stuff here. But that's, I think, Anthony, the point is you're absolutely right. If you get cases like that, we'd look through the options.
Just give us a call and talk it through.
Yeah. So, just wondering if any other questions are coming through, gents, either of you, either you or Jeremy. Jeremy, do you have anything to add? Are there any questions that came up which are worth you commenting on?
Probably fortunately for us, there weren't too many questions today, Mark. I think we were a bit worried that we might get mired in some sort of technical questions with solicitors, which we think are best dealt with offline anyway. But Tim in the chat box mentioned that this is utterly terrifying from a negligence point of view. So his note was that should always seek advice, and I think that's absolutely right. If we've got big pensions in play, then perhaps the letter of instruction, as you mentioned in your presentation, should give BlueSKY the ability to pass comment on those issues to make sure that everything is covered.
Yeah, great point. I try and steer away from the scary thing of negligence, but I think solicitors are very are quite aware, or should be aware. Of course, there are instances where sleepwalking, if you like, into giving financial advice just through the general discussion you've had with your client is ever present, and certainly the bigger the case, the bigger the issue. So yes, thank you, Jeremy. Right. Well, look, I think the questions have pretty much dried up. Thank you once again for your attendance. You will, over the next couple of days, be sent a copy of the slides and the recording. So thanks ever so much for listening. Hope to see you back here later on in April. And goodbye for now. Thank you very much.